All right. Can we all see my screen? If you can see my screen, please just signify, then we move on.
Yes, I can see your screen.
All right. Thank you so much. Fine. Okay, so good evening once again, my professional colleagues and then ladies and gentlemen. So like I said, we are going to be looking at accounting for climate change. Accounting for climate change. And I believe you all know what it means when you say accounting for climate change. It means we are trying to account for how the climate, how the climate have been affected in our books. And there are so many things we'll be discussing as we move on. So from this aspect, I'll be having the objectives of this. So this course provides an overview of climate impacts. Then another part we'll be looking at is the role of accountants in this climate impact. The third one is climate risk and opportunities, including financial impacts. And the third aspect of this is impact of climate-related matters and the financial statements. Climate and the financial statement. How do we recognize it? Please mute yourself if not permitted to unmute. Okay, thank you so much for that. So please just mute yourself for everyone. It also establishes the requirement of common climate-related standards and framework. There are some standard, there are some framework that was designed mainly for climate, we should be looking at as we move on as well. Okay. What are the learning outcomes? We should be able to assess the impact of climate change on the financial statement. We should be able to evaluate regulatory and compliance responsibilities as they relate to climate change. Okay. So the content of what we want to discuss, like I said, is overview of climate change, understanding of the framework, and standard for climate-related disclosures. Understand climate risk and opportunity. There's going to be risk, and for every risk, there's also opportunity. So it depends on which one are you tapping into. Then, effects of climate change or effects of climate change on financial statements. So let's look at the modules. So we are going to be looking at overview of climate impacts, understanding climate-related frameworks and applicable standards, and what are the standards that is going to affect. Then understand climate risk and opportunity. Deep dive into climate impact on the financial statements. Now let's start fully now. So for module 1, we're having the introduction to this climate. This module introduces us to climate change. It provides an overview of its causes and some regulatory policy to checkmate the rise of climate change. Presently now you will see that the weather is getting too hot more than the necessary. And sometimes you will sleep, you will not even be able to sleep yourself. You won't be able to sleep well, especially at the midnight or in the afternoon. You will see that the weather is changing, the climate is changing, and it's affecting every living thing. If we continue this way, the heat and the changes will have impact, significant impact on the living things, especially human beings and the plants and the lights. Okay? And there's something we call ozone layer. Years back, like 5 or 10 years ago, they discovered that that ozone layer is getting weak. And this ozone layer is the one that actually covers the sun, that is not getting too heat to the human or to the living things. So we look at it, they said it's getting weaker and weaker. So which means we also need to, as human beings, as living things, we have to take note of that, and we have to find solution to that problem. Now, when we look at the overview of climate change, according to United Nations, climate change refers to long-term shifts in temperatures and in weather patterns that has been significant changes in climate over the decades, like I said. And what are the cause or causes of this climate change we are talking about? We are talking about the human activities, using generator to run every activities. You will see in a building, in a particular house, different people will on their generator. If they are 10 in that building, if they are 10 in that premises, in that compound, you will see 10 of them will make sure they have their generator, and everyone will burn the generator because everyone want to feel comfortably, but they don't know what they are releasing exactly into the climate, into the atmosphere. Deforestation, when they cut trees, okay, especially using the tree to get wood, get our building materials and the paper and the lights. Then manufacturing products with large reliance on fossil fuel, plastic, iron, steel, all these manufacturing companies that produces plastic materials, that produces rubber, nylon. You will see that they use most of these, they release most of this pollution into the atmosphere. Is echoing. We can't hear clearly. Okay, thank you so much. I believe it should be fine now. Okay, probably two of your devices are close to each other. Okay, I'm good. I think it's better now. Can we confirm if it's better now? So just drop message so that I will know that it's better now. Okay, I think I have a message. It's better now. Okay, thank you so much. So we talk about manufacturing that are producing nylon, they are producing plastic, they are producing shoes, rubber, and the likes. You will see that they release so much pollution into the air, and all this pollution are going through to the climate, and the climate will give us back what we are releasing into the atmosphere. We also have food production. Those who are selling, they use wood to prepare food and the like. So definitely the smoke is going straight to atmosphere, and that will come back to us. The same thing to transportation. 3 people of 10 people have cars in an organization. Instead of them to come together to the office, we can use 2 or 3 cars. Everybody wants to go with their cars, with their vehicles. And going with their vehicles, they are going to release what we call smoke into the atmosphere, which is going to definitely affect our weather, our climate, and every other thing. Okay, now let's move on. Then we also have natural activities that actually affect the climate. We have volcanic eruptions, we have variation in Earth's orbit around the sun and the light. So that is not where we are actually going through. We are just trying to introduce what the climate change is all about, and as an accountant, what is our role in reporting this particular climate change, and what is the standard that we have to apply.
I'll be
Okay. Now, overview of climate change. The shift in climate is caused by emissions, termed greenhouse gas emission, that blankets the earth and cause global warming due to heat trap in the atmosphere. Okay, I think I've explained that. Asia Pacific is the largest emitter of CO2 globally, and China is the biggest emitter in the region. You know, China is in Asia, so Asia is the largest producer of this climate pollution or emitter. Then, particularly China. Then Nigeria is number 1 of the top 5 largest emitter in Africa. Nigeria is number 1 of the top 5 largest emitters in Africa. And that is more reason why we, as Nigerian, as a chartered accountant of Nigeria, we must find this topic very interesting. The next one is the power industry is the largest emitter with about 100 companies generating approximately 71% of the global emission. So the power industry, what are the power industry? We are talking about like oil and gas power and all this. So there's what we call based on report by Carbon Disclosure Project. Then we also have global emission has been on the rise and a major cause of concern for the world. So this rise in this emission has caused the leaders of the world to come together and say, see, in the next 30 years, in the next 20 years, something else might happen if we fail to take the responsibility now for what we are doing. And let's move on to the next slide. So from this next slide now, the policy to checkmate the increase in carbon emissions. So everybody now comes together to see, we need to control this emission that we are releasing into the atmosphere. And what are we going to do? This related to tax levy for carbon emission. So they now say, okay, fine, there's going to be tax for those who are releasing this carbon into atmosphere. So that's why we have this relate to tax levy for carbon emission. Its main aim is to reduce CO2 emission by imposing tax levy on each ton of greenhouse gas emitted by business. So if your company is into green gas, or if your company is a company that releases this emitter into the atmosphere, there's going to be tax apportion. There's going to be tax that they're going to impose in that kind of industry. Another thing is cap and trade. This is a system of controlling greenhouse gas emission by placing a limit on the amount of carbon an entity can use at a particular time. If a company needs more permit to make its product, it has to trade with another company to buy them. What we are saying is simple. There's going to be a limit of what you can use or what emission you can produce, you can consume. For example, a company that is into production of plastic, they can apportion that, see, you cannot use more than 5% so amount. Once you exhaust that particular allocation to you, you cannot produce again. Now, in case, let's assume we have 3 companies into plastic production. Company A, company B, company C. If company A have like 1%, company B has 1%, company C has 1% of emission to release into atmosphere. Once company A is done with your own 1%, it cannot produce, it cannot go beyond that again. That is what we call cap. That is benchmark. However, if company B and company C are unable to use their allocated 1% to them, What are they going to do? Company A can go to company B or C, purchase the remaining emission given to them, and use it to produce more. That is where the accounting role is coming from. But we are not going there yet. We are just taking it step by step. So how do we account for that type of transactions? Those are the things we are going to be looking at as we move on. Then we have international agreements. The Paris Agreement, where more than 190 countries gave their voluntary commitments to reduce their emission within specific time frame. Okay, so in that meeting, different countries now gave the agreement. See, we have three solutions. The one is that we impose tax on the companies that produces this emission. The second is that there's going to be something like cap and trade. That is, you can't go beyond what you are assigned to you. If you want to go beyond that, you need to look for another company that has not fully used the allocated emission to them. Then the third one is international agreement. And the international agreement we are talking about here is in our national declared contribution, NDC. It was stated that Nigeria pledged to reduce greenhouse gas emission by 20% by 2030. Don't forget, Nigeria is one of the top 5 that is producing or that is releasing this emission in Africa. Now Nigeria is now pledging that, see, by 2030, we are going to reduce this emission by 20%. How are they going to do it? We are going to look at it as we move on. This pledge raises to 47% on the condition of international support around climate, finance, technology transfer, and capacity building from the developed countries. Nigeria announced that it will aim to reach net zero emission by 2060. The first agreement is that by 2030 they will reduce it by 20%. Then by 2060 they are going to make sure the emission is zero at the COP 2060 Climate Summit in 2021. The Climate Change Act was enacted in 2021. I hope you all know that there's even something called Climate Change Act as of today. Okay, so if Nigeria has promised to reduce by 20%, and by 2060, they said, see, we are going to make sure we eradicate anything called emission. What is now the way forward? Let's move on. If you have questions as we move on, you can be dropping. I'm going to have a time to discuss and to ask questions. Let's deep dive into emission trading now. This emission trading schemes and their objectives. Like I said, objective is simple. Is to reduce what we call this emission. And to reduce this called emission, what they can do is that they can get data of all companies that produces emission, that releases this emission into the atmosphere. And what are they going to do? They will allocate to them what they can produce, what they can release into atmosphere. Once you go beyond that schedule or that allocation, you cannot produce again. The only thing you can do is to what? Is to trade from other companies that are yet to fully utilize what was assigned to them. I don't think we need to dwell more in this aspect. So let's move to the next one. Okay? Now, what is this Africa 3 approach saying? The first one is intangible assets, government grants, and liability. We are going into accounting aspect of it now. Now, when this allocation is given to you, and you have it in your own financial statement, it becomes an intangible asset to you because it's going to give you rights to generate revenue. And we have fair value, you can measure it at fair value, and also you can measure it at costs or revaluation model. So initial recognition and measurement is that you can measure it at fair value when it's issued to you. If government is saying, House of Accountants, we are going to issue 7% of gas emission, total gas emission produced in Nigeria to you. It means once they give me that 7%, I can calculate if that 30%, if that 7% is going to be like 1 million ton of emission I can produce. So I will recognize that, I will value that, and recognize it as intangible asset. That is an allowance to me. Then I have to do the fair value every year. That's as initial recognition. Then the next one, I can be doing revaluation model on the cost model. Now, the government that is giving to us, we are going to look at it as a government grant. So it's going to be different between the nominal amount for allowance and the fair value. And what are we talking about? I think I should come back to the revaluation model here. The model apply when allowance are traded in active markets. Okay? At active markets. Then surplus on remeasurement recognized in other comprehensive income, that is normal. Then deficit on remeasurement recognized in profit or loss. Then reversal of surplus or deficit recognized in OCI. It's still the normal accounting process we have been doing. The only thing is that we have to recognize this right, this allocation as an asset. And what type of asset is going to be an intangible asset? Okay? Now, the government grant is going to be like a government grant. That is, the government is giving us this particular grant for us to operate. And we are going to have the difference between the nominal amount for allowance and the fair value. And we recognize it in P or L over the scheme period. If the grant given to us is to operate within 1 year, then it's going to be within 1 year. If it is for 5 years, then we also spread it over 5 years, and then we continue to amortize for that 5 years. Now, cost model, intangible asset measure at cost less amortization and impairment. I want to believe we are good with that. Now, you can also have another aspect of it that talks about liability, which is the provision. An emission and made provision is recognized, measured at best estimate of expenditure required to settle present obligation at the end of reporting date. Generally, be by reference to the fair value of allowance required to cover emission made up to end of reporting. What we are saying here is simple. Okay? Don't forget the first two transactions, the first two entry is talking about the company that was granted the allocation and the government that is granting that allocation. Now, in a case whereby this company finished the allocation within a particular period of time, and they still want to increase the production, they can actually go into liability, that is, get that from the third party for them to operate. We are still going to that in detail. I don't want to jump for now. For most allowances traded in an active market, no amortization is required. Offsetting of asset and liability is also not permitted. Okay? Now, let's move on. What are the role of accountants? By the time we start taking this one by one, so what should be the role of accountant in this matter? Role of accountant is number one, bring the subject of climate change on the agenda of the board. so that they understand the financial implication associated with the climate change. That is first role of accountant. Now, like this training we are having now, like this webinar we are having now, most of the management, most of the board are not aware of this information. But as for us, if we can tell them, if we can educate them, if we can put them on slides and open their eyes, from there they will understand what it entails and the implication at the head. Number two is that apply accounting principle to help. Okay, so sorry for that break. So let's continue from where we stop. Okay, so we can continue. Now, what we are saying is that applying accounting principle to help present climate-related information in consistent, comparable, and reliable manner. What do we mean? What we are saying is this. There are so many accounting standards we are going to be looking at as we move on that are related or that are going to be affected as a result of this climate change. And as an accountant, you must know what and how to treat all the standard in the financial statement and what would be the effects on this particular information. Number three is that identify and measure climate related risk and the opportunity. So there are some risks attached to this climate change, and there are some opportunities that are also related to this climate change. So we just have to dive into opportunity and then know how to manage the risk. Number four, understand investment and how to plan the entity investment to transition to low carbon economy. That is, we should plan, strategize, so that we know that there's a way we can reduce this carbon we are actually burning. For example, if you are a kind of person that always your compound, your business, your organization is 24/7, they must on the generator and disturb the atmosphere and affect the climate change. Why are they not going for solar? We have so many alternatives. And why is your company not go into solar system? If you are looking for business to start, why not go into solar? Many people, by the time we start talking about this climate change, many people will start reducing, especially if Nigeria has promised that by 2030 they are going to reduce it by 20%. And they started applying the tax levy, they started applying the portion allocation of what you can generate. Many people will start running from generator to what? To something that will make the life easier, like solar energy. Okay, so from there, we are going to be seeing where to invest. We are going to see opportunity rather than risk. Then understand the new rules and its impact on your company. So if government declare now that you cannot produce more than so ton of emission, you must make sure you understand the rules and how it's going to affect your company as a whole. The next one is that consideration of non-financial data and how to keep relevant data. Here we are looking at, what the company, what the government are planning is that they are going to say you cannot use more than 1,000 emission in a year, for example. So how are you going to account for that 1,000 year? 1,000 ton? How will you be able to monitor what the companies are actually contributing? Okay, we are going to, I can share the calculation later. I may not be able to look at that calculation aspect. For example, anything like vehicles that the organization is using is going to be part of the emission you can produce. Then anything like generator is going to be part of the emission you can produce. Then company that is into production, whatever you are producing from that plant and machinery is going to be part of the calculations. So if you cannot produce more than 1 ton, you must know how to calculate all these things. You must know how to keep all the records intact, so that in case the government come to you and they are doing their investigation, you must know how to defend your company. So to actually implement this in Nigeria, it might be difficult, but I think it's something that is possible. If other world can do that, and recently now, I'm hearing more of sustainability report. We are going to look at what IFRS H1 and what IFRS H2 is talking about by the time we get there, and you will understand what I'm trying to discuss in that aspect. Okay, so let's move on. Now we are in module 2 now. What is module 2 talking about? Overview of climate standard and framework. So we are going to be looking at standard that actually talk about this climate change. Then we are also going to be looking at overview of the TCFD framework for climate disclosure. We are also going to be looking at overview of the greenhouse protocol. Okay. We are going to be looking at greenhouse protocol. Then after that, we are also going to be looking at overview of the ISB standards. That is IFRS S1 I'm talking about, and S2. Okay, so let's take it step by step. Now let's come back to common ESG reporting standard and framework. So I'm just going to make sure I don't want to go beyond 8:30 or 9 o'clock. If I'm taking it too deep, it's going to take us more than that time, but I'm going to make sure I summarize so that we will understand, and I will also release the slides so that you can also go to your companies, educate them, let them be aware of that, and we are good to go. Now, so we have the framework aspect of this. Task Force on climate-related financial disclosure. So that is TCFD. That is Task Force on Climate-Related Financial Disclosure. And the recommendation. What is the recommendation? Another one in the standard. The standard we're talking about here is, sorry. So the standard we're talking about here is the Sustainability Accounting Standard Board standard consolidated into the ISSB. Then the last one is the greenhouse gas, which is the protocol. So very quickly, let's look at the purpose of this. The recommendation for disclosing the climate-related risk and opportunity that are mostly pertinent to an entity business activities. So, in our notes to the account, we have all these, what do I call it? Available space for you to disclose. Though this one are not in financial terms for now, they're not in quantitative, but it has to be presented. The information, what is the tones of gas you are using? I'm still going to be showing you all that as we move on. Then we also have industry specific disclosure standard across ESG topics designed to communicate how sustainability issues impact long-term enterprise value. Okay. Then the last one is accounting and disclosure standard for companies to measure, manage, and report greenhouse gas emission from their operations and value chain. So, we have what we call sustainability reports. And in this aspect, so companies are they're supposed to report how they have been taking care of the environment, how they have been giving back to the society. Okay, if they are a kind of company that always cuts trees, use the tree to produce, or uses to for house or plant wood materials and stuff like that, they ought to report on that, and they must be able to see what is the replacement. Are you planting trees in replacement of what you are cutting? How are you protecting the environment in which you operate, and the like? Then investor and other provider of financial capital, those are the audience that are interested in this particular climate change. Investors and other providers of financial They are almost the same. So I don't want to actually waste much of the time here. Then same definition as financial reporting. Then ESG information that is reasonable, likely to have significant effects on the financial condition, operating performance, and market valuation. I think we can move away from here. But before we move ahead, let's look at the focus areas. The climate-related risk and opportunity, addressing 4 pillars of governance, which is governance, strategy, risk management, and the metrics and targets. Okay? Why the definition of set of sustainability topics and associated metrics for a typical entity is an industry based on investor interest in an issue and evidence of material financial impact within an organization. Don't worry, let's go to the next one. We don't need to actually waste much of our time. I think I need something to discuss there. Don't worry, let's go to the next one. Now, when we are talking about this governance aspect, describes the board oversight of climate-related risk and opportunity. Also describe management roles in assessing and managing risk and opportunity. What we are talking about is here for the governance aspect. The management, the board of directors, they also have their own responsibility to make sure that they are monitoring what the company is actually releasing into the organization, into the atmosphere. And they make sure that they have responsibility over this control. Whatever they can do, what are the things they can put in place for this to be effective and done. Then we have the strategic aspect. What are the methods they are going to use, they are going to employ for them to make sure that they control this climate-related risk? Now, the first one is opportunity and the organization has identified over the short, medium, and long-term period. So they must be able to identify the opportunities. Then describe the resilience of the organization's strategy, taking into consideration different climate-related scenarios, including a 2OC or a lower scenario. And the third one is the impact of climate-related risk opportunity on organizations, business strategy, and the financial planning. Then when we talk about the risk aspect, this describes the organization process for identifying and assessing climate risk. So what are the risks that can occur? Okay, if as an organization, if you are not the one producing this particular emission, another company is producing this emission to your company or in your environment in which you operate, you must know the risks that are attached to that. And then you must be aware and get ready for what you can do to protect your own organization. Describe organization processes for managing climate related risk. And the last one, which is the metrics and target, disclosure the metrics used by the organization to assess climate related risk and opportunity in line with a strategy and risk management process. So the next one is describe target use by the organization. And the third one is disclosure, scope 1, scope 2, and scope 3. I'm going to be explaining what that scope 1, scope 2, and scope 3 is all about. Don't worry, we are here to get to the standard aspects. And I may not be dwelling so much on this. This one may not be interesting to the accountants, but these aspects, you will need it to explain to your board of directors so that they will actually know what you are driving at. Okay. Now, greenhouse gas are gas or gases in the atmosphere that traps heat and increase greenhouse effects. The greenhouse effect is a natural process responsible for keeping the earth at the temperature needed to sustain life. Then the greenhouse gas protocol establishes comprehensive global standardization frameworks to measure and manage greenhouse gas emission from the private and public sector, operations, value chains, and the mitigation action. That is, how are they going to do to reduce all this risk, to mitigate it? Now we look at the carbon dioxide. Is the most common and widely known greenhouse gas. It is the main competition for vehicles, power station, and etc. So these are the smoke that all these vehicles are releasing, and the companies and the like. So what are the types of greenhouse gas we are talking about? We have carbon dioxide, we have methane, we have nitrous oxide, we have industrial gases like fluorocarbons, we have perfluorocarbons, we have sulfur, and the like. All these one are the gases you are talking about that an organization must make sure they work on. That is not where we are still going. I don't know, maybe I should jump all these ones, or I should just try to summarize what it's all about. Overview of the green gas protocol and the standards we are about to talk about. So we have the scope 1, like I said, scope 2, and we also have what we call scope 3. These are direct emission from combustion within the entity, what you burn yourself. So this scope 1, when you are now, this is where we are now going now. We are going into where that the one that will be beneficial to accountant. Now, when you want to report this, don't forget I said if you look at the advert, or how do we call it, I put adjustment to IAS1, IFRS S1 and S2. What we are saying is that it is now mandatory, okay, for you to report on this sustainability report. And when you want to report, you have to put them in scope 1. You must report the one that is under scope 1. You must report that is one under scope 2, and you must also report the one that is under scope 3. What do we mean by scope 1? These are direct emission that the company burn, like fuel, like gas. If you are a company that uses generator big plants to run your business activities, that type of gases that is coming out from your generator, or the smoke, that is the scope 1. So you are going to calculate what you have generated for the whole year through the generator, through the vehicles, that is for organization, through what again? Every area. It depends on the industry you belong. That is what we call scope 1. Now, the scope 2 is talking about these are emissions from purchased or acquired electricity stream, heat and cooling. These indirect emissions are consequence of your organization energy use, but occur at a source you do not own or control. What we are saying here is that the electricity that you are using is not being burned, the gas or whatever emission that is coming out through that electricity is not being burned by your company. You are not the cause of that gas, but because you are indirectly partaking in that, then they are also going to calculate that. And whatever you have in that area will be under scope 2. Is gas flaring by oil company part of scope 1? Yes, because they generate. Thank you. That's a good question. They generate. It's part of what they generate. So it will be in scope 1. For company that is into oil and gas, like electricity now, like what do you call them? Power holding company. That gas they are producing, it will be in their own scope 1. Why the scope 2 will be we that we are using the electricity. Though we are using the electricity as a result of what? As a result of indirect. We are not the one producing that gas, but we are using it because we partake in that particular activities. Then, if we look at it, we also have what we call steam, and heat and the light. Now, the third scope is talking about other indirect source of emission in an entity. Or before I go with that scope 2, the scope 2 says, but occur at source you do not own or control. You cannot control the gas that is coming out through electricity because it's not your company. You are only enjoying the benefits that is coming out from there. That is scope 2. That is how you must know. By the time you understand that, you will know which of this cost is going to scope 1, which of this is going to scope 2. Okay? Now, why do we need to arrange all these things in scope by scope? Because by the time the organization is giving that allocation, they will know which one you have or which one you actually you have borne, and which one is not coming directly from you. Then scope 3 is talking about other indirect sources of emission in an entity, value chain, everything beyond what you can burn or buy. For example, we have business travel. Even if you are not traveling, if you like, don't even travel out of Nigeria. As long as the airplane is flying over, or your managing partner is traveling from Lagos to Abuja, as long as it's going to be part of that plane, there's going to be a certain gas or emission that's going to be released through that airplane. You are going to be part of that. Then employment commuting, waste generated in operations and waste disposal, purchase goods and services, transportation and distribution tied to supply and customers. I believe I'm making sense. Now, carbon dioxide equivalent is the common unit of measures used for the calculation of carbon footprint. Conversion tables are used to convert all emission to carbon dioxide equivalents. Data collection is usually a challenge. To gather all this data is a challenge, and that is why an accountant needs to be aware of that. But to calculate it, there's a particular table. They call it conversion table. If you use 1,000 ton of carbon dioxide, if you put it on that conversion table, it's going to convert it and also value the amount for you to bring it into the financial statement. Okay, let's move on. That's not where we are going yet, but I think you are getting to the foundation of it. Now, this is what we are talking about. This is the statement of greenhouse gas emission. Below is an example of greenhouse emission disclosures. And if you look at it, we have scope 1. You can see that scope 1 I'm talking about now. And if you look at it in 2015, 2014, you will see they produce or generate 12,205. Then we have 12,000. And the changes is 1.7%. And we also have 11,713. Okay? Then I believe you still remember what we are going to have in scope 1. This is what you burn yourself. Then scope 2 is what other burns, and it is beyond your own controls. So we have 815, we have 870. You see the way they report it? Then we also have scope 3. This is the figure they have, and the changes here is 4.0%. Now let's look at it. Voluntary carbon offset for scope 1, carbon neutral services. We have that. Voluntary carbon offset for scope 2 and for scope 3. Now, step to consider in calculating carbon footprints. Have a good understanding of the 3 scopes. That is first one. Brainstorm on the sources of emissions for your organization. You must know where this particular emission is coming from. Then gather and keep necessary data for the sources of emission. So if you have 5 vehicles, you must make sure you have that 5 vehicles. It will not be acceptable again that we give 2 official vehicles to directors or to the top management, and they will bring it to the office. And when they are going home, they will need to take their children, take their family that is not related to financial, that is not related to business activities. So they have to be cautious of that. Plan ways of reducing the carbon emission by setting measurable targets, that we are not going to go beyond this. If 5 management are going out, it means they'll be using 1 vehicle or 2 vehicles so that they can reduce. It's not that all the 5 management will take their own vehicles, and that will be credited to the organization greenhouse gas. Okay. I don't know. I think I can skip this. Dive into carbon offsets. You can read the materials on your own. I don't know how many slides I have more to go. Recognition and measurement, and this one is more important to us as an accountant. So what is recognition and measurement? If entity is acting as a broker or a trade, carbon offsets are likely to be considered inventory. Okay. When not acting as broker or trader, carbon offsets are either inventories or intangible assets. Don't forget, at the beginning, we have what we call the inventories, and we also have what we call intangible assets. It should be an intangible asset if the government is giving us that grants to use 1,000 tons. But I'm very sure that there are some companies that will use this as opportunity. And what they are going to do is simple. What they're going to do is that, see, okay, fine. So please just give me like, so what we are saying is this. It means there's going to be some people that will take this as an advantage. And what they're going to do is simple. They're going to start having the allocation from government, and then you will not be, they will be the one you are going to contact if you want to get more emission. They may not into even production, or they are not using more of that gas. They are not releasing more of emission into the atmosphere. So they are going to have enough for them to trade in the process, and people will start buying from them. So in that case, it's going to be their inventory in their own financial statements. Now, when we are talking about the one of intangible assets, first thing is that non-monetary asset without physical substance. So it's not going to be physical substance, but we are going to value it, measure it. Then the recognition when retired. Then initial measurement at cost. Then after initial measurement, we are going to have initial recognition measures using either cost model or fair value. I think I've discussed all this in the process of this introduction. To apply fair value model, fair value of carbon offsets must be capable of being measured by reference to active markets, identify life until retired, tested for implements, because you must do that every year. Okay, that is why you look at the fair value method. If the value has reduced, or if there's an impairment, or if the cost you are carrying is still as it's supposed to be. Don't worry, I still have a final part that will summarize everything. Then we have what we call acquisition with immediate retirement. Flights emission taken by consult employees. Let's look at this. We have 480,000 metric tons. Voluntarily commit to, I think I have a message. Are there any conditions or standard used to allocate to companies? Okay, so we are still going to talk about that. we are even yet to talk about the standard. That's why I'm jumping so that we talk about the standards that are actually affected. But we have seen the aspect of scope 1, scope 2, scope 3 that we need to actually take note of. Okay. Purchase carbon offsets. I think I can jump on this one. Don't worry. You can read up this one yourself. I think I'm getting to where we are talking about the standard aspect. Now, overview of the ISSB sustainability standard. Okay, that's IFRS S1 and S2. IFRS S1 is generally talking about requirement for disclosure on what? On sustainability. Requirements disclosure on sustainability. And the second, which is IFRS S2, is talking about climate-related disclosures. The two are very they are very close, but they are not saying the same thing. The first one is talking about disclosure on sustainability. The second one is talking about climate-related disclosures, which we are going to be looking at in full details. We are still going to module 4, so we are in module 2. That is why I'm trying to run as fast as possible so that we can cover everything within the stipulated time. The International Sustainability Board, ISSB, released 2 standards in June 2023. You can see that is very close. Many people are not aware of this yet. The sustainability, and the last time I also attended ICANN webinar, they also talk about sustainability. Okay, I think it's from FRC. So they invited one of the FRC member, I think maybe their secretary or so, to also discuss on sustainability. So you can see that they are trying to make people aware of this standard. And that is what we are talking about. So the sustainability report or sustainability standards were published in multiple cities of the world, including Frankfurt, Santiago, Singapore, Montreal, New York, London, and Lagos, Nigeria. I think we need a round of applause for Nigeria as well. ISSB was established by the International Financial Reporting Standard Foundation in November 2021 with the aim of delivering a comprehensive global baseline of sustainability related disclosure standards that provide investors and their capital market participants with information about companies' sustainability related risk and opportunity. For every investors, they want to know about the companies they want to invest in. They want to know what is likely things that the company is going through. And that is why when a company is reporting on sustainability reports, okay, they're going to be having more investors. Investors will have more, they will have trust in that organization. They will know exactly what they want to go into. They will know that this company are a bit open, a bit straightforward. Okay, and that is one of the reasons why the sustainability report, and even currently now, they are FRC are making it compulsory for audit firms to make sure they have sustainability reports in their financial statement. And when I say financial statement, that is governed by IAS1, presentation of financial statement. So if in your financial statement, you are going to have what we call sustainability report, it means there's an adjustment to that. And these are the adjustments we are looking at presently. When we get to that, we are still going to talk more about that. Then the ISSB will build on the framework of existing investors, focus on reporting initiatives such as the Task Force of Climate, the Climate Disclosure Standard Board. Then the Value Reporting Foundation comprises of integrated reporting framework and the SASB standard. Okay. What is the overview of IFRS 1, the requirements or disclosure on sustainability. The objective is to require an entity to disclose information about its significant sustainability-related risk and opportunity that is useful to the primary users of general purpose financial reporting when they assess enterprise value and decide whether to provide resources to the entity. So we have the 4 aspects we've talked about before. An entity shall apply IFRS 1 in preparing and disclosing sustainability-related financial information in accordance with Financial Reporting Sustainability Report Standard. An entity may apply IFRS Sustainability Disclosure Standard when the entity-related financial statements are prepared in accordance with IFRS, that is the accounting standard, or the other GAAP, maybe NGAAP or USA GAAP or whatever. As long as you are preparing your financial statements, as long as you are preparing your financial statement in accordance with IAS1, you must obey the reporting standard, which is the sustainability, which is this IFRS S1 that we are talking about. Then the sustainability related risk and opportunity that cannot be reasonably be expected to affect users' assessments of the entity enterprise value are outside the scope of sustainability report financial disclosures. Okay, so I'm still going one by one. I think I should be getting closer to that now. We know about fair presentation, reporting entities, connected information. I think we can read all this one by ourselves. When we're talking about report materiality, sustainability related financial information is material if omitted, misstating or obscuring that information could reasonably be expected to influence decision that primary users of general public financial reporting make based on that reporting. So if there are information about sustainability and you as an accountant or you as an external auditor, you fail to report on that, especially if that information is material and you omitted it, then you know that you are violating what we call the materiality concepts. Okay, entity specific, no specific threshold of material, applying judgment to identify material sustainability related financial information, releases materiality judgment at each reporting date to take account of changes in circumstances or assumptions. Let's leave this one. You can simply read this one yourself. Let me just summarize the IFRS S2 as well. This one is talking about the climate-related issue, which is climate-related disclosures. The objective of this is to require an entity to disclose information about its exposure to significant climate-related risk and opportunity, enabling users of the entity general purpose financial reporting. You know, if you tell me that you are exposed to certain risk of climate or whatever, this may stop or this may caution the investors Okay, so what we are saying here is that the climate-related disclosure, you are required to disclose all these related issues about this climate. Because before the investor will come to your organization to invest, they want to know the risk and the opportunity you are exposed to in organization. Okay? And what is this talking about? If you look at it here, we have to assess the effect of the significant climate-related risk and opportunity on the entity's enterprise value, to understand how the entity's use of resources and corresponding inputs, activities, outputs, and outcomes support the entity response to the strategy of the management. So they want to know what activities you are into and what are the things you are actually giving back to the organization or to the community as a whole, and what are the risks, what are the opportunity you can tap into. You know, if you have a good company, if you have a good finance or board, all these things will be checked in and out before you can advise them to go for any projects, to go into any investments. So you are going to look at everything and make sure that whatever they want to do, you check due diligence on every organization before you can advise your management to go into a particular investment. Just like what we have been saying, the governance, strategy, risk, measurements, and every other aspect. So you can read all this one yourself. They are straightforward. Let's just try to go to the final part of this presentation so that it will not take too long. By the time you read all this one, I believe you still remember scope 1, scope 3, scope 2, scope 3, what the metrics are all talking about. We also remember what the risk management is all about, how the body ensure that the appropriate skills and competencies are available to oversee the strategies. We also look at the time period, the identify risk and opportunity will impact on its business and the like. We can leave all this one to read on your own. Once you read it, you understand. Let's also jump this. Climate-related risk, opportunity, and financial impact. Okay, we can look at this. Let's look at the risk that can come from here. We have the policy and legal. We have technology, we have market, we have reputation. If we start from policy and legal, government can decide, can declare a certain policies concerning this sustainability or concerning this particular climate, so that they will be able to have the control as promised. So what do? It's going to having impact as a risk on organization. Then the technology, they will need to make sure they go into different technology. Sorry for that break. So this is where we stop. So we are looking at the risk. We are looking at the policy that the government may be imposing on business or on companies. Then we also look at the technology, the market, and also the reputation. So if you are unable to control this and you are asked to report all this in the financial statement, then it means you'll be having physical and you'll be having reputation. People will start saying that company, don't buy from that company again, because they will keep destroying our environment. Okay. For example, by the time government announced that nobody should buy, nobody should use generator, and they are giving them the consequence of what the generator is causing to us, the atmosphere, how is disturbing it, and there's alternative that they can actually use solar energy and the light, you will see that many people will start leaving, they will start abandoning the generator and going for the alternative. And from there, it will have negative impact. It will have risk on the companies that are producing the generator. I have a question. What criteria will be used to determine the quantity of emission allocated to the government? I mean, by the government. Okay, I'm going to talk about that. We are still having somewhere to go. If I didn't talk about it at the end of this class, please just ask at the end. But I'm going to get there as we move on. So we are looking at the risk and opportunity. We have strategic planning and we have financial impact. So opportunity here is talking about resource efficiency, energy source, products and services, market resilience. In this case, don't forget, for every risk, there's opportunity there. It's now dependent on you to know that this is the opportunity which I must tap into. Okay. Now let's look at how it's going to have impact on the financial. The first one is that our revenue and expenditure is going to have impact on revenue. If you are a company into that generator, you see that it's going to affect your organization. Is the standard effective or under review? Okay, I'm still going to answer all that as well. Just continue to drop all your questions. So also the expenditure also will increase, which will affect your income and the like. So it's going to definitely, since it's going to affect revenue and expenditure, it's going to have impact on income statements. It's going to have impact on the cash flow. Also going to have impact on the balance sheet as the time may be. I'm trying to run fast so that I can take questions. I can make it interactive, but I just want to make sure I cover all the aspects you need to know. I think by the time you read all these aspects, we should be good. We should be okay. And I think I'm almost done. This is the place we have been waiting for. And that is the standard we are talking about. Don't forget, I said this standard is as at June 2023. If you look at it, you will see that it's still new, very, very new. And in the next, it might be this year as well. In the next few months, you'll be hearing more about it. ICANN is aware of this already, and there is ongoing training and then what do you call it? Awareness for everybody to know about this. For ICANN to also call Secretary of FRC so that they can educate chartered accountants in Nigeria and how we can make sure we contribute to the success of this standard. Now, financial impact of climate risk. If you look at it, you are seeing so many standards that is going to be affected. And let's start from IAS1. If you see it from the corner here, you will see IAS1. The IAS1 here is talking about presentation of financial statements. And if we go back to the paragraph, what we have discussed, we are having 25, 26 to 26. And then we also have 122 and the likes. What is it actually talking about? The sources of estimation, uncertainty, and significance judgment, sensitivity analysis, and key assumption and going concern. What we are saying here, this is answer to your question. You said, how will the government be able to measure the allocation? What they are going to do is what we call the estimation. It won't be certain, but it's going to be based on estimation and significant judgments. Okay, if we are giving you tones, we are giving you 1 tones, we are giving you 2 tones. I believe they are still working on this strategies they are going to use. And that is why the answer to the other question is that this standard is still under review, but we need to be aware of it so that when it comes, we will know that we just key into it straight away. So it's going to affect our presentation, as I said. Then number 2 is IAS2, inventories. The climate may lead to obsolescence, which might impact the net realizable value of the inventory. If you are a kind of traders, like I discussed, you are not having this as an asset or intangible asset, but you are having this as inventory in your books. So it means that inventory will be at risk because you may be having what we call the obsolescence. And as we move on, so value of inventory IS2 require the write down of those inventory to their net realizable value. Okay, then how about the income taxes? The recognition of deferred tax assets might also be impacted. You know, it's going to be assets now to you, and you are going to be doing the revaluation every year, or you are going to be doing the revaluation every year, because you need to know the value you are carrying it, if it is high or it's low. And the tax people also will be doing their own, the temporary difference and permanent differences. All these also will be calculated in our next webinar. I think we'll be talking about that the factors adjustment as well. We look at what we need to take note of. So this standard also will affect the factors. And IAS 16, you know, this thing is going to be reported as intangible assets. So it's going to affect IAS 16 and it's going to affect IAS 36. I mean 38. IAS 38 is talking about intangible assets, while 38 is talking about PPE. It can affect the residual value and expected useful life of the asset. Okay. Then the next standard I will be talking about is IAS 37, the provision, contingency liability, and contingency assets, which is going to talk about, if you go back to the slide, you are going to see where we talk about liability and provision in brackets. So the provision aspect will be affected by IAS 37, and we must know what to how to treat it. In this case, it may affect the recognition, measurement, and disclosure of liabilities. Contracts may become onerous, and levies imposed by government. I want to make sure I leave space for questions so that we can discuss at the end of this. Then IAS 36 is talking about impairment of assets. Impairment of assets or impairment assessment of goodwill, PPE, intangible asset, etc. Impact on cash flow forecast incorporated into VIU. Let's see the other aspect that is going to affect. We have IFRS 9 financial instruments. It may affect the lender exposure to credit losses, loan contracts. IS7 is talking about financial instrument disclosure. So it's going to affect the fair value, because we are going to be using fair value every year. It may affect the fair value measurement of asset and liability in the financial statement. It may affect disclosure on the fair value. IAS 16, we've discussed about that. Then insurance contracts. For those who are writing account, we have to take note of this insurance contract, especially these diets. If they're not testing it, they tested it in PSAF last diet. Also, climate-related matters may increase the frequency or magnitude of insured events, or may accelerate the timing of the occurrence. It may affect the assumptions used to measure insurance contracts. You can read all this up yourself. Financial impact on climate risk. We have cash flow forecast. We have cost of capital. When we're talking about the cash flow forecast, we have scenario analysis. It's useful in understanding the potential impact of different climate scenarios We have different effects on the cash flow. Then cash flow may also be directly affected in the instances where prior growth expected. Thank God, I think I'm done. I think I'm done with that. Okay, so I've actually rushed it anyway because I don't want it to be too long. So I want us to have question. If you don't have question, I will share the slide. Then you can go through the slide and you'll be fine with it. So let me see. I think I have a question here. How do you describe this standard as an asset to the company? Okay, if I want to describe this standard, it depends. It can be an asset and it can also be the other side. What we are saying is that what I mean by asset, because the government is going to give you grants, they are going to give you is it control, to use that word, so that you'll be able, excuse me, okay, sorry about that. Okay, so you can assume this to be assets. Okay, we can assume this to be asset to the organization because that right that the government is going to give you is an intangible asset, which means you will have the permission to produce, to use that to generate revenue. And don't forget, the definition of asset is when you have control, when it's going to bring economic value to the organization, there's going to be inflow into the organization. And this actually meets the definition of asset. So that is why it's going to be an asset organization and not a liability. Okay? For it to be either inventory or to be asset or intangible asset. So it means it's fine for the organization. Thank you so much for this presentation. Thank you so much for this. So you are welcome. This is just first one this year, and we have so many presentation for this year. You are welcome. Thank you. Thank you, sir. You are welcome. So do we have more questions before we go? If you don't have any other, I'm going to share the slide. You can look at it and okay, I think I have a question. If my company share allocation to other companies, will they pay? Now, the thing is that your company will have its own allocation. Then other company will have its own allocation as well. Okay. So what is going to happen is simple. If you finish using your own allocation and other companies are yet to get their own allocation, you can trade, you can buy from those who are not using their own allocation at full utilization. So you can get part of them. They are going to charge you. You buy from them. Then you can use it to run your business and get yours and to get your revenue as it may be. When is the next webinar, sir? Okay, the next webinar is going to be in February. We do this one every month. So this is January. We have been doing this since last year, webinar every year. So you can go to our YouTube channel, Arts of Accountant Professional Services. They're going to see so many webinars we have. We've talked about budget. We've talked about so many tax, VAT and withholding tax and the like. So you can go back and check on our YouTube channel. We also have Arts of Accountant group chat, WhatsApp group chat. Over 2,000 people are there. And we also run ICANN lectures as well, in case you are joining out of accountant group chat. So you can chat me later and we talk, or however you get the number, I can add it to the platform. We discuss about accounting related matter, audits, tax, and then ICANN. Okay, so is there any other question before we stop for this for this night? Then we can meet next, which is February. I want to believe there's no other question. Okay, I'm going to share the materials on the platform. So just thank you so much for coming. Thank you for listening. At least having you is a wonderful. I'm happy I have you around to discuss. Let us meet next month as we continue our discussion. Thank you.